If equity investors believe a treasury company has the right management team in place and the right capabilities to raise and grow the value of the crypto held per share to go up, it should always trade at a premium to its net asset value. That's what MicroStrategy has proven. But if someone's just saying, I'm going to put Bitcoin on my balance sheet, I should get my stock price go up, that's never going to work. Ethereum would be very undervalued if you were looking at Circle relative to layer one. So that's why Ethereum probably could go to 10,000 or something. If the world suddenly realized we're going to tokenize more things, and like these tokenized assets like tokenized dollars trade at 100 times EBITDA, what should the blockchain be valued at? So then suddenly ETH should maybe be worth a lot more money.
Lee dives deep into the mechanics behind Bitcoin Treasury strategies and highlights how Ethereum's role in tokenization could drive explosive long-term value. His perspective bridges the gap between equity markets and crypto, showing how capital markets behavior, corporate balance sheet strategy, and decentralized network architecture are colliding to reshape modern finance. Whether you're an investor trying to understand why MicroStrategy trades at a premium, or you're wondering if Ethereum is still undervalued amid the tokenization boom, this breakdown offers a macro perspective few can match. Tom Lee doesn't chase hype. He tracks data, precedent, and capital flows to paint a compelling picture of where crypto is heading and how savvy investors can position themselves for generational opportunities.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
The biggest, most recent lesson is what happened from February to April. Like this year, we had a black swan with tariffs.
Yeah.
I mean, it caught everybody off sides and off guard, and we had basically a mass liquidation of the stock market, waterfall decline. And we gave very unpopular advice to our fund strat clients, which is don't do anything because it's going to be a V-shaped recovery. We said every waterfall decline is a symmetric bounce.
Yeah.
And we had so many people saying, yeah, it might have worked in 2022, it might have worked in 2020, but it's not going to work this time because the Fed's not behind your back. And we said it won't matter. And so a lot of people liquidated, but guess what? We had a V-shaped bounce. I think there's two things to keep in mind. One, there's plenty of precedent for treasury companies in the historical stock market world, whether it's master limited partnerships, but it's also like the energy industry, like a commodity industry. ExxonMobil was for 25 years, the largest or the top 5 largest company in the S&P 500 for a single generation. Like you could have been born, like graduated high school at 20, and by the time you're 50, the biggest stock in the market was still Exxon, okay? It was never valued off earnings. It was always valued as a multiple of its reserve of oil, and it never traded at the value of its oil. It always traded at a multiple higher. And so that means in the market dictionary, if equity investors believe a treasury company has the right management team in place and the right capabilities to raise and grow the value of the crypto held per share to go up, it should always trade at a premium to its net asset value. That's what MicroStrategy has proven. But if someone's just saying, I'm going to put Bitcoin on my balance sheet, I should get my stock price go up, that's never going to work because that doesn't create that ability and the attractiveness, which I described earlier about why treasury companies are attractive. Like can they lower their cost of financing to grow their coin holdings per share? And if they can't, it should trade at NAV. So I think the bifurcation you're highlighting is the market's conclusion that not everyone's going to be able to achieve that. Circle, which has been a very successful IPO, and it's been the most successful IPO like in the last few years, and it's crypto. I mean, crypto has been one of the best equities and now the best IPOs. But Circle trades at around 100 times EBITDA. So, a 1%, yield, you might say, or a 1%, EBITDA yield. I mean, it's a pretty sizable multiple. But stablecoins really operate off a layer one. So, a lot of Circle operates off Ethereum. And if you look at the tech stack, typically, the more you get into that layer one, sort of level, the higher the multiple should be for the business because it actually benefits from the multiple applications sitting on top of it.
Yeah. No, that's a good point.
So then if you...
Sorry.
Yeah, so on that symmetric Ethereum should have a staking yield. The yield should, if the enterprise, Ethereum should have a much higher multiple. And
Well,
so I asked that to Sean Farrell. He said, if you do the rough math, you get Ethereum would be very undervalued if you were looking at Circle relative to layer one. So that's why Ethereum probably could go to 10,000 or something. If the world suddenly realized we're going to tokenize more things, and like these tokenized assets like tokenized dollars trade at 100 times EBITDA, what should the blockchain be valued at? So then suddenly ETH should maybe be worth a lot more money. ETH treasury models, and there aren't that many. There's a couple out there, including the one that was announced yesterday. There's a bit of an advantage of a Ethereum treasury company if you directly compared it to a Bitcoin treasury. One is that there is a yield you can earn on Ethereum by staking. So you actually can grow your Ethereum per share from that income activity. The second is that Ethereum's delivered volatility, so it's a measure of how much it moves, is actually twice that of Bitcoin. So in theory, if someone had looked at it as like a capital markets access, like following MicroStrategy's model of trying to earn more crypto per share, well, Ethereum's volatility actually makes it cheaper to fund purchases. So because the higher the volatility you have, the more you can sell volatility and then lower your cost of borrowing. And the third is, of course, that because it's a staking token, a treasury company actually can also act as an operating business on the network itself. And that's important because that ties back to something I'm originally thinking about, which is that as more things in the financial world and real world become tokenized, then financial institutions like Goldman and JP Morgan and Amazon Walmart, as they do stablecoins, are also going to want to stake Ethereum itself. So we're essentially doing the underlying architecture of what other businesses will actually do. So we're essentially getting in front of what other businesses will do.
Tom Lee argues that not all crypto-aligned companies are equal. What sets MicroStrategy apart is its ability to accumulate Bitcoin per share through low-cost financing and strong treasury strategy, earning it a premium valuation similar to how ExxonMobil was valued for its oil reserves. He also sees Ethereum as severely undervalued, especially as the financial world begins to tokenize real-world assets like dollars, stocks, and private equity. Ethereum, being the base layer for platforms like Circle, is becoming the financial plumbing of a new digital economy. And with staking, higher volatility, and utility baked in, ETH could realistically reach $10,000 or more. Lee notes that ETH treasury companies might be even more powerful than BTC ones due to built-in yield and active network participation. Ultimately, the key isn't just holding crypto, it's in understanding how companies can compound it, manage volatility, and plug directly into the financial systems of the future through smart capital strategies.
I like the Bitcoin treasury model. MicroStrategy is really the blue chip of that. And MicroStrategy is a granny shot ETF in the granny shot ETF. And because it's big enough now to be included on the major indices like the Nasdaq 100. But what makes MicroStrategy attractive is that he's accumulated enough Bitcoin. He's accumulated almost 600,000. That is so much Bitcoin that he has what I call a sovereign put, meaning if the US government ever wants to create a Bitcoin reserve, well, they can either try to buy 1 million Bitcoin in the open market, or they'll buy MicroStrategy at a huge premium. So there's no way MicroStrategy should ever trade at net asset value. And then because of the volatility of Bitcoin, MicroStrategy in turn can use the capital markets to raise money at much reduced cost. Like if he held Bitcoin, it'd be very expensive for him to borrow money to buy more Bitcoin. So if you own MicroStrategy, he's working to give you more Bitcoin per share every day, and actually at a efficient cost. So over time, you're owning more Bitcoin, so you benefit from the Bitcoin going up, plus he's getting you more Bitcoin per share. Ethereum has a vibrant and active community that's working every day to kind of create and improve it. And there are, it's a smart contract platform. And so to me, Ethereum might have actually languished and lacked innovation for some period of time, and that's really what um, that was behind the fact that Ethereum sort of hadn't moved much. But I think that the fact that there's now tokenization taking place of real financial assets, and you saw with Robinhood the idea that they're going to be tokenizing a lot of things, including private companies. I think that there is going to be a real look back at the layer one networks that offer a lot of utility with smart contract, but they're secure because they're actually US based, or a lot of the validation takes place in the US. And so that's why I think Ethereum really stands to benefit. I know that there are other chains that have a lot of stablecoins, such as Tron, but one of the challenges, of course, is that that a lot of the activity on that takes outside the purview of the U.S. There was a date where, like, there was a registration statement effective, and then someone had written, like, I think the crypto world is not really used to SEC filing, so then they see this registration statement, and then someone like Roadstar, like, oh, everyone's dumping their shares. And I think in crypto, that's common because they would call that a rug pull. They're like, oh, there's a rug pull about to happen. And but I think that that's you're right. Over time, people learn different behaviors. I mean, I would say the most successful crypto traders actually are quite gifted, and they actually do quite well trading equities. But the thing is, in the equity world, there's been a lot more value created by not trading. I don't know if you saw the tweet by Chamath Palihapitiya, but he said, I think yesterday, that, let me try to find it, but he was basically making a reference that if he had never sold any of his VC bets, he'd actually have like $30 billion more money.
Tom Lee's core message is about discipline and strategic exposure, not hype chasing. He cautions against confusing crypto speculation with long-term value creation, drawing parallels between equity markets and crypto behavior. In his view, real wealth is built not through flipping altcoins or reacting emotionally to headlines, but by aligning with high-conviction trends and management teams that know how to use capital markets to increase crypto per share. Ethereum's rising utility and tokenization, combined with Bitcoin's hard money roll, offers a dual path for long-term investors. Treasury models that leverage these protocols intelligently, like MicroStrategy with Bitcoin or future ETH-based treasuries, can offer exponential upside if executed well. But Lee warns, leverage is powerful but dangerous. Stick to owning great assets, avoid the noise, and let time and compounding do the work. That's how you win in this market, by thinking bigger, holding smarter, and ignoring the short-term drama.